Hello and welcome to the next topic that we're going to be covering in general accounting called accounting principles. Generally accepted accounting principles, or the GAAP, are all the rules and concepts that financial accounting is governed by. We have to understand these principles to best use accounting data. The GAAP aims to make the information relevant, reliable, and comparable. And relevant information affects the decisions that we make as users. Reliable information is trusted by us as users, and comparable information is helpful in us contrasting different organizations. The first principle that we're going to go over is the measurement principle. This is also called the cost principle or historic cost principle. This principle is extremely important because it reminds us to measure the actual cash value for transactions, not what we think the transaction is worth. A good example of this is, say your company buys a truck, which costs you $10,000, but you can get $15,000 worth of work out of it, just say in revenues. Maybe you rent out the truck, or maybe you use it to transport goods. But you would not count the truck in your asset account, because if you remember when we went over what an asset was, truck is an equipment, so it would be an asset account. You would not put it down as a $15,000 bonus to your asset account. The reason for this is we don't want to over or understate asset accounts or liability accounts or equities account. And now we're going to look at the measurement principle with the accounting equation. And just as a quick reminder, the accounting equation is assets equal liabilities plus equity. In the previous example, we had the truck cost us $10,000, but to us it was worth $15,000. So let's work it out. But before we do that, remember, a cost is an expense. So an expense is an equity. So you replace equity in this with the $10,000. And since the truck is an asset to us, we would replace the asset with $15,000. So we would have the $15,000 of the truck not equal to the $10,000. This is the main reason for the measurement principle, just to make sure that the accounting equation is balanced. Now we're moving on to the full disclosure principle. The main thing about this one is that companies have to report all details behind financial statements. This just helps investors, employees, government agencies, and etc. to have all the correct and useful, reliable information and also to help us know how we received our revenues and expenses. Now we're moving on to one of my favorite principles, the revenue recognition principle. Simply put, you have to recognize your revenues when they are earned, not when you receive them. So if you are in a bookstore, like in a college bookstore, and they sell you a textbook for $200, the student decides to make a down payment of $50 because that's all the money they have in their pocket, but they promise to pay the full $200 over the semester. So the bookstore made a sale of $200. They sold a book for $200, but they only received $50 cash. So in their revenue tab, when they open it up to do all the accounting statements for the day, they would have to put, even though they only got a $50 in cash from the student, they would have to put in their revenue account a full $200 revenue. So the reason that they can do this is that they have an account receivable from the student as well. This is why it balances out the equation. So they have the $50 cash plus the $150 account receivable that the student owes the bookstore equals the $200 revenue account. And now we're going to go over the revenue recognition principle and its importance. If revenue is recognized too early, your firm can look more profitable than it actually is. And one really great example of this is, say you own a lawn care business, and one of your customers has a small plot of land that they want you to take care of for the entire summer, a 3-month period, and they decide to pay you $1,200 up front. Now, you haven't done the work yet. This is before you actually do all the work. So you and your accountant decide to place the $1,200 cash that you got from your client in your revenue tab. Now, if investors came along and they saw that in 1 month you earned $1,200 when you're averaging, say, when this is like could be far beyond what your average actually is, then they would want to invest in your firm because it looks so profitable. And that is essentially lying to investors. Your information is not very reliable or relevant. Now, if your revenue is recognized too late, then your firm looks less profitable than it actually is. Take the bookstore example. If the bookstore doesn't recognize the full $200 revenue that they received, even though they only got the $50 cash, then the university may close down the bookstore because it looks like they're basically giving away textbooks, and that's a waste of their time and money. Now we're going on to the flip side of the revenue recognition principle, the expense recognition principle. This records expenses that are incurred to generate the revenue reported. And in layman's terms, for every revenue you have, you're expected to spend money, because you know the old saying, you got to spend money to make money. This is essentially that. It reports the expenses you use to earn what you have paid for. So basically it's the same thing as the revenue recognition principle. You have to report your expenses when you use them. A good example of this is insurance. As many of us know, it's cheaper to buy insurance in blocks. Like say if you buy it like every 3 months or every 6 months, it's cheaper than instead of buying it 1 month at a time. Now, if you recorded the expense, the insurance expense, in 1 month, so say you spend for 6 months of insurance, you spend again maybe $1,800. If you recorded all that expense for 1 month, if an investor came around and saw that expense, they would be flabbergasted because your firm would not look that profitable since you spent so much money at a one-time thing. Now, if you were able to spread that expense out over each of the months, then you would look a lot more profitable than you actually were. It's important for basically the same 2 reasons the revenue recognition principle is. If your expenses are recognized too late, then your firm looks more profitable than it actually is. If your expenses are recognized too early, then the firm looks less profitable than it actually is. And this is going to be the final principle that we go over today. Thank you all very much for watching, and I'll see you all next time.